Hi, my name is Mary. I am a realtor in the state of California. In this video, I will explain what are the metrics and factors that lenders are looking at before approving home buyers for a mortgage loan. And I will explain in depth what a debt to income ratio is. I hope you will enjoy this video. If you are looking to make a home purchase, you should know what you need to do to get yourself prepared so that you can get pre-approved for a mortgage. One way to do this is to educate yourself on what lenders and banks are looking at before approving you for a loan. To maximize your chances of getting pre-approved for a mortgage, it's a good idea to look at what metrics and factors lenders use to evaluate your financial profile before approving you for a loan. Lender will look at your DTI ratio, which I will provide a detailed explanation in a little bit. They will look at your LTV ratio. I make a separate video on this LTV ratio. You can find a link in the description. They will look at your credit history, your FICO score, your income, and your employment history. For those of you who are looking to make a home purchase and are wondering when you should get pre-approved for a mortgage, you may want to watch a different video that I made on how to get pre-approved for a mortgage. You can find a link in the description. So what is a DTI ratio? DTI ratio means debt to incomes ratio. Your DTI ratio measures all of your monthly debts relative to your monthly incomes. The lender adds up all of the debts and your new mortgage payment, and then divide the sum by your gross monthly income to get a percentage. So for example, your monthly debts has auto loans, student loans, credit cards, personal loans, revolving charge accounts, etc., and the new mortgage payment. And now your gross income has W-2 incomes, investment incomes, business incomes, interest incomes, or child support if you have a child support. To calculate the DTI ratio, you will take the monthly debts divided by the gross monthly income. And if you want to get a percentage of it, multiply by 100. You will get a percentage. Lender typically wants a DTI ratio of less than 43% of your gross monthly income. So depending on your loan type, borrowers should maintain a debt to income ratio at or below 43% of the gross monthly income to qualify for a mortgage. The higher your debt to income ratio, the more risk you pose to the lenders, and therefore you would be more likely to struggle to repay your loan on top of your other debt payments. One point worth note-taking is having a lower debt to income ratio can qualify you for a more competitive interest rate. So it makes sense that before you make a home purchase, try to pay down as much debt as possible. You will not only lower your DTI ratio, but it also shows the lenders that you can manage debt responsibly and pay your bills on time. Lender will pull your credit reports from the 3 main reporting bureaus: Equifax, Experian, and TransUnion. They'll look at your payment history and whether or not you pay your bills on time, how many and what type of credit lines you have open, and the length of time that you've had those accounts. In addition to positive payment history, lenders analyze how much of your available credits you actively use. This is also known as credit utilization. Maintaining a credit utilization rate at or below 30% will help boost your credit score. Lenders will also look at your income and employment history. When you apply for a mortgage, lenders will go to great lengths to ensure that you earn a solid income and have stable employment. That's why lenders request 2 years worth of W-2 tax forms and contact information for your employer. Essentially, lenders want to ensure that you can handle the added financial burden of a new mortgage. If you are looking to make a purchase of your first home or your second house, then you should watch the video I made on tips for home buyers. You can find the link in the description. Have a great day. I hope you enjoy my video, and we'll see you in the next video.